You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. And Jane, this is our New Year's edition. It's the first day of the new year, so we want to wish our listeners a very happy, healthy new year to start with.
That's right. Healthy and happy. And that's very important in today's world. Happy New Year.
Yeah. So the new year brings a lot of excitement, a lot of energy. There's a lot of, hopefully there'll be a lot of good things for our audience. But one of the things everybody, unfortunately, will have to consider getting ready to do at some point is to get their taxes ready. It's going to be tax season. It's going to be here before you know it, come February, come March. And with owning property and with owning principal residence or investment property, there's a lot of real estate. You need tax knowledge to know what's deductible,
you need an expert.
What's not deductible. So yes, you need an expert, and we have a tax accountant expert with us today. He's back for a second show. He joined us last year, and it was very informative, and we had to have him back. So without further ado, we'd like to welcome Ajay Kumar of CPA Services. AJ's, of course, a CPA, and we're going to talk about some general guidance as to real estate tax accounting principles. Again, this is just general guidance. If you have any specific needs or consultation or need your help with your taxes, please call AJ. So AJ, welcome to our show.
Thank you, Ken. Thank you, Jane. And a very, very happy new year to all our listeners. I'm happy to be here. Thank you for inviting me.
Thank you. Hey, AJ, before we start, are there any rules or any chance that the IRS could eliminate the taxes? Are we going to give anything at all?
I wish so, yeah.
Or maybe.
I don't think you wish so, because if that's so, the content will lose half of the business.
No, at least put more on the corporations and leave the residents of New Jersey alone, right?
There are a lot of states who do that. Say Florida, Texas. There are some states that do not have the personal tax. And in those states, they try to recoup the money from the businesses.
You're right. But the businesses, I guess, are already stressed to a certain point, so they have to get something from the residents. But we're not going to cover all about the taxes. We want to concentrate on the real estate aspect of what's deductible, because our show is primarily about real estate. So we want to tie in, but with home ownership or with owning investment properties, there's a large aspect. It's very important that the audience has some general ideas of what's tax deductible and what's not, so they know they can do their homework during the year or at this point and gather the necessary information. So when they go to see you or do it themselves, they have what's the knowledge they need to properly fill out the paperwork.
Absolutely, Ken. You rightly said. A little bit of preparation can make a huge difference to the tax liability. So we cannot eliminate the taxes. IRS is not going to remove the taxes, but the onus, the responsibility remains on the listeners, on the individuals, to do some homework prior to selling the house, buying the house, so they can plan for their taxes properly.
Absolutely. So this show, we're going to try to cover the principal residence tax deductions, and then the latter half of the show tie in the investment properties, what's deductible. So let's start with the principal residence. So in New Jersey, if it's your marital home, I guess it's defined as your principal residence. And let's talk about if anything is deductible, assuming you don't sell the house first. Is there anything you can deduct, whether you have home repairs or a mortgage interest? So let's talk about that.
Absolutely. So if you are a homeowner, you need to listen to the show, Ken and Jane show. There are certain deductions, including but not limited to property taxes, the mortgage interest. Unfortunately, property tax is limited to $10,000, and it's not just property tax, Ken. It's sold, state and local tax. Property tax is a type of local tax. It's paid to the municipality. So state income tax and local municipality tax, including the property tax, is all limited to maximum of $10,000.
Oh, so in other words, if the state, or I'm sorry, the property tax, let's say, is $7,000, but then and then the other taxes you have are $4,000, you can only claim $10,000. If the total is $11,000, you lose that $1,000 is not deductible.
Absolutely, especially in New Jersey, most homes have property tax over $10,000. Most people work in New York or have W-2. So their state income tax is already over 10,000. So a lot of people in New Jersey loses the complete deduction for property tax because the SOLT, state income tax and local tax, including the property tax, is limited to $10,000.
Right, and I believe that this limitation was passed in the prior Trump administration. It's a federal because IRS is the federal body, because I remember that New Jersey and some of the northeastern states where the property taxes are typically could be more than 10,000 were hit the hardest. Whereas if you're in the Midwest or some of the more property tax friendly states, there was no real reaction. But I remember New Jersey residents, we reacted a little bit stronger because in New Jersey, most property taxes, not unusual to have homes with property taxes exceeding $10,000 per year.
You are 100% right, Ken. So the rule was passed under CARES Act that came in 2017 under Trump administration. And there were a lot of talks about the blue state and the red state and the blue states being more affected than the red states. But I mean, it doesn't matter how it happened and when it happened. Right now, this is what we are stuck with.
Right.
Yes.
That's right. Yes. Exactly. Okay. So how about mortgage interest on if you're a homeowner? A lot of people have a mortgage. So the deduction on the mortgage interest, is there a limit on how much you can deduct, or you can?
There is and there is none. So mortgage interest by amount has no limit. You can deduct mortgage interest as much as you are paying, except up to the principal value of $1 million. So take an example. If your loan value on your primary home is $1.5 million, this is what the loan you took. You are only allowed to deduct 2/3 of the mortgage interest because the principal mortgage, that amount cannot be more than $1 million for it to be deductible. But take an example. Let's say there is one individual who is paying 10% interest on $1 million.
Mm-hmm.
This individual is allowed to deduct $100,000. But then there is another individual who has $2 million of debt at 5%. This person is only allowed to deduct $50,000. So there is no limit on the amount as such, but the debt amount has to be up to or under $1 million.
Okay, that seems
That's
like it's
very important because it's not the property purchase price $1 million or the value $1 million. It is the debt. The mortgage is $1 million.
Absolutely, Jane. You are 100% right, Jane.
Mm-hmm. The mortgage interest amount.
The mortgage amount.
Mortgage amount.
Mortgage amount is
below $1 million.
$1 million.
Which is most of the people fill in that category.
But some may fall outside that category,
Yes.
especially in New Jersey. You have a lot of luxury homes in Colts Neck and other areas where there's multi-million-dollar property. So,
but majority, the mainstream like us, definitely, the house not even worth $1 million, leave alone the loan.
Right, that's right.
The property is not worth
But it's
that.
interesting. I didn't know that. So there's not an unlimited cap. The cap is like, as AJ just said.
The amount is unlimited.
Yeah.
If your amount is less than $1 million in debt,
as long as
and let's say you are paying hypothetically 30% interest, you are allowed $300,000 deduction.
Yes. Mm-hmm.
So there is no cap on the amount as such. Is the mortgage debt amount?
That amount is $1 million cap.
Right. Okay. I think that's more leveled out the playing field.
I agree.
That's more leveled out because if you can afford $1 million more debt, right, the property value has to be really much higher than the average income earners. So, yeah.
Right. So in other words, if you have a mortgage, if somebody homeowner has a mortgage debt of $2 million, are they allowed to deduct up to $1 million of that?
They're allowed to deduct up to 50% of their total interest.
Oh, okay. That's another. Gotcha.
Oh, another gap.
Okay, another gap. So that's why that's why they really need to consult you because
before. If you have $1.5 million, you only allowed 50%.
50%.
No, two-thirds.
Yeah.
I'm sorry.
So you weren't paying attention.
No, I'm sorry.
But I would like to remind our listeners, if you have any question, a lot of this information is very case sensitive.
Yeah.
So please mention Ken and Jane show, and you will have free consultation.
Oh, yes, thank you, AJ. Yeah. Thank you.
And if anybody wants to get in touch with you, AJ, I was going to give that at the break too, but please, why don't you give your contact number now, because your phone may be ringing off the hook after hearing some of this.
Absolutely, and I'm glad you mentioned it. I'll give you my number, my cell number, my office number. My cell number is 908-380-6876. My office number is 908-888-8888. 8901 210. So we have 12 lines, 8900, 8901, 8902. But if nobody's picking up the phone because the phone is off the hook, please call my cell. Please text me at 908-380-6876. Mention Can and Jane Show, and you will definitely get the call and free consultation.
Oh,
Right.
thank you.
And your office is located centrally in East Brunswick, right? And what's your address, please?
We have two offices in New Jersey, one in Monroe, one in East Brunswick. Our East Brunswick office is 1 hour court. We are on second floor, East Brunswick, New Jersey.
Okay, perfect. Great. Let's continue talking about the principal residence. So now we're going to switch gears to if a homeowner sold their principal residence in New Jersey in the tax year 2022, talk about the tax consequences and the limitations and the qualifications if you are exempt from the tax.
So as long as the homeowner has been living in that home for at least 2 years before selling the house in most recent 5 years, there is no tax consequences as long as the gain is under $500,000, assuming married filing joint situation. For a married filing separate or single filers, the limit is $250,000, meaning $250,000 of capital gain is non-taxable.
Okay, that's good. So let's do an example because there's something important to realize about the gain, how the gain can be reduced that the listeners may not realize. If a listener bought the home 20 years ago and they paid, let's say hypothetically $250,000, they sold it 20 years later, let's say for $1 million. So on paper, the gain would be $750,000. So there would be some tax consequences. However, why don't we take a break and then we're going to talk about why it's important to keep the receipts and other home improvements, how that can reduce your gain.
You know what, Ken, just want to give everybody a question so people can think about during the break.
Yeah, for the new year, right? And they get their cup of coffee that they're going to need to start the day after that was a long night last night.
Yeah.
We'll be back right after these messages. Okay, welcome back to our show. We're joined today with Ajay Kumar of CPA Services. And AJ, let's continue that example of how the basis, why it's important for a homeowner to keep their home improvement receipts and how it can reduce their gain, which could be consequential if they're a married couple and their gain is more than $500,000. Anything over that $500,000 would be taxable. But however, the homeowners can do certain things with home improvements, like if they put $50,000 into improving their kitchen and other things. So if you can expand on that principle, please.
Absolutely, Ken. So the way it works, your basis in the property is the purchase price, including the commissions that you had to pay to anybody, plus all the improvements, capital improvements that you have done in the house, including but not limited to painting the house, fixing the kitchen, fixing the bathroom. In our example, if you bought the house 20 years ago, then more than likely you have fixed a lot of things in and around the house. It may be roof, it may be floor, it may be outside garden, it may be the patio. If you can maintain such receipts, and the receipts have to be substantiated by the payment, meaning you can't just collect all the receipts from the vendors, from the contractors. You have to show the proof of payment, and it has to be contemporaneous, meaning you cannot really say, I got this receipt for 2002, and here is the payment voucher that I did in 2010. If you have a receipt, an invoice in 2002, IRS would want to see a payment in 2002. I mean, the year is not important, the timing. Let's say if you have the invoice of December 2002, you want to see the payment in January 2003, February 2003, meaning within the same period, in the same time. And you don't have to sort of create an Excel spreadsheet. I prefer using a shoebox approach. Create a small box wherever you have the improvement, whatever receipts you have, just throw it in there. So if the need be, in 10 years, 15 years, 20 years, you have a place to go and add up all those receipts to justify that even though I bought the house for $250,000, I had improvements worth $300,000. So even if I'm selling the house for $1 million, my actual gain is under $500,000, so I don't owe any taxes.
Right. That's a very good point, AJ. You mentioned about proof of payment. So in that scenario, would the IRS want you to show a proof of a cash check as well? Because otherwise, on a receipt, you could write paid on January 1st, 2022 check number, but then they could take it one step further and say, well, show me that if you're saying the receipt is not good enough, then I would assume the IRS wants either the credit card transaction receipt or the canceled check receipt if they were to do an audit.
Absolutely. We would want to see the bank statement somehow, or the credit card statement that clearly shows that the payment actually went out of your account to somebody else.
So an important thing for listeners to keep in mind is that if you do a major improvement, it's important to get a copy, or unless you have it online. A lot of it's online for 7 years or so, but it's important. I think it's important in this day and age still to get a paper copy. If you paid $50,000 to a contractor via checks, and you should keep a paper copy, because maybe in 20, 30 years, you won't be able to go back online and get those bank receipts. So it's just a good practice, right?
You are 100% right. The good thing is, even though the individuals like me and you cannot go to bank after a certain number of years, but IRS can. If you have a cancelled check, if you have a proof of check, IRS can summon the bank and verify if the check was paid.
Oh, well, that's comforting too.
Yes,
that's good. That's
absolutely.
that's a fail-safe feature.
Absolutely.
And that's comforting. Only they want to catch you. Right. It's not like you claim the IRS going to go there help you to get a receipt. If you don't have a receipt, you may not able to.
But
claim.
it's good if you truly did have the receipt and you couldn't find the check, the canceled check. Then it
has to be big amount.
Yeah.
I think that today's the day technology is so advanced, right? I mean, you have a receipt, you have a payment check or credit card. Just take a photo and save that in your
Google Drive,
and that would be there always. Make a year to 2023, and today's the first day. You just start a year, so whatever you make that, so you don't have to your fingertips, right?
Absolutely.
So a lot of time our client asks for some past year's information. Used to be we have to put a request in, dig out the box. The boss have to find where the storage, because normally only up to 6 years, 7 years. So now you just own in the drive. So
and the shoebox approach is still good. What I've been doing now is still using the shoebox approach for the paper receipts, but also taking the liberty to use my phone or scanner and scan them into the Google Drive. So like for restaurant receipts and things, but still keep both. Even though it's more arduous, but it's good. You never know what could happen if there's
if the electronic gone.
You have the paper, and if the paper is gone from a fire or something, you have the electronic. Hopefully,
if the electric gone, you have a paper.
Right.
Absolutely.
Okay, good. Let's switch gears now and talk about investment properties. We spoke. Let's talk about what's deductible for the landlords in New Jersey on a federal and state level if you have an investment property and you have repairs during the year, pest control, cleaning services, and miscellaneous.
Absolutely, Ken. So the short answer is everything. Any expense that you wouldn't have had if you did not have this property is all deductible expense. You may not get the tax benefit immediately, and we'll explain that in a minute. But for the investment property, there is no limit on the property tax. You can deduct the property tax, whatever the property tax is, 100%. So if you recall in the first segment, we reminded our listeners that the property tax has a limit of $10,000 that includes the state and local tax. But for the investment property, there is no such ceiling. There is no such limit. If you recall in our first segment, we reminded our listeners that there is a $1 million DAT cap on the primary home. There is no such DAT cap on the investment property. So if you have an investment property, 8 apartment building, and you have a loan of $4 million, all the interest that you are paying is all deductible interest.
Okay. Yeah. All the repairs are deductible.
The repairs, the insurance, that's another thing. Right. Home insurance on the primary home is not deductible, but the insurance on the investment property is a deductible expense.
Right.
Anything that you pay to the realtor in terms of finding the rental property, the commission fee, the insurance, the repair, the water bill, anything that you have for this property that you wouldn't have had if you did not have this property in theory. It's
Right.
all deductible expense.
Here's another question. I know sometimes. How about if the landlord travels to the property to view, if there's a problem or an issue? How about the mileage costs? I know I've heard that is a possibility. Is that deductible?
That is deductible. So the IRS provides certain rate. 57.5 cent was for 22. So IRS provides these rates as how many miles you have, where you live, where is the rental property, how many times you went there, and it all has to be reasonable. If you say I went there 30 times in a month to collect the rent, you are inviting the audit. But if you say 1 time, 2 times, it's all fair. You put the mileage, you put the rate, and that's a deductible expense. What you cannot deduct is your time. Say I'm an accountant, I earn $10 an hour. And I say, you know what, it took me 2 hours to go there. So my time of $20 should be paid too. That's not deductible. What's deductible is my primary home and my rental home is, let's say, 20 miles away. I went there 2 times, going there, coming back, total 80 miles at 57.5 cents. That's what's deductible.
Mm-hmm. What about appliances? Typically with rental properties, like everything in life, things break. Refrigerators, washer, dryers. After a certain amount of time, things don't last forever. Unfortunately, that's just the reality of the world we live in. How are capital improvement expenditures accounted? Accounted for. We're talking about accounting. That's the best word. Accounted for in the accounting scheme.
So for the residential property, we typically use 27.5 years of depreciation on the main structure, but then the appliances don't last 27 years anymore.
Yeah.
So then for the appliances we have to use either 5 years or 7 years depending on the type of appliances. Longer the duration you use, lesser benefit you are getting for the depreciation. Because let's say if you bought something for $7,000 and you choose 7 years depreciation.
Yeah, let's say a refrigerator. Let's say you got the best refrigerator, which is probably not even 7, probably much more. But let's say 7,000.
And you use 7 years of depreciation. Then you are claiming $1,000 every year for next 7 years, as opposed to using 5 years of depreciation. We are using $1,400 of deduction. So IRS prefers you use longer duration as opposed to the shorter duration. If you are buying a refrigerator and trying to push for 3 years of depreciation, you are inviting problem. So, and you have to also know that a lot of rental losses, let's say your total income is $30,000 in the rental income and your total expenses, including depreciation, mortgage interest, property tax, everything is $36,000.
Right.
So in theory, you have a loss of $6,000 that you are trying to get the benefit. But on your tax return, you will find that it's being pushed as a passive loss and your income is not coming down. You're still paying tax on the same amount. And the $6,000 is a suspended loss. You're not getting the tax benefit.
Okay. You just don't owe any taxes on the rental property, but you can't apply that passive loss to your active
active income.
Right. So that's why they carried over, I guess, the next
year or until you sell the property.
Okay.
In that case, it's very important not to go out of your way to claim more depreciation than necessary. If you're not getting the tax benefit anyway, then why go for a smaller duration, increase the depreciation? Because if the loss is 6,000 or 8,000 or 10,000, it doesn't matter. At the end of the day, you're not getting any immediate benefit. It's just lowering the basis for your property.
Right. But let's go back to the question on depreciation and the timeline. I know that residential structures have a 27-year, but I thought aren't they fixed? Isn't everyone required to have the same useful life claim, 7 years or 5 years? You indicated in the previous answer that people that I guess the accountants or the individuals can kind of pick and choose.
Yes, you can.
It's not rigid. It's not fixed. That if all appliances are presumed to be by the IRS on a 7-year cycle or a 10-year, there's latitude in that?
Absolutely. Say for example, you have a rental property, nice rental property, and you had to fix the loan. The loan is not going to last 7 years. The loan will have much lesser duration. So there is a study, it's called cost segregation study. Extend this example to a commercial rental property where you have a motel. The motel has the 100 rooms. They have the microwave to bed and a lot of fixing around. In that case, having a cost segregation study will be very helpful, where you can have the assets divided into 3 years, 5 years, 7 years, and 27 or 39 years type of bucket to claim the right depreciation.
I see. So I guess the follow-up question is, are the buckets fixed by the IRS? That either your choice are either 3-year, 5-year, 7-year, or the 27-year?
There's 10 years as well.
Okay, so you can. It's not totally random, but you have to. So the taxpayer or the accountant is given the some discretion as to what bucket to place the appliances in based on the scenario. If it's in a motel where it gets a lot of wear and use, it could be on a shorter scale, because the likelihood is could wear out after 3 years, or maybe some apartments that get a lot of heavy, maybe with college kids that are using it, their refrigerator won't last for 7 years, only lasts for...
And really depends on how expensive its appliances get. For example, if you have a rental property, you have a $1,500 refrigerator, $1,500 or $1,000, you could obviously 3 years, 5 years.
And you don't have to have it new.
Yeah.
Sometimes we have these used equipment where the life will be much lower than if the same equipment was new.
Exactly.
Yeah.
I mean, that's really
so it's very So there's a lot of scenarios, even though it's accounting, which is numbers. There's a lot of there's a lot of record keeping, a lot of you have to be very detailed, but there's a lot of case by case, a lot of judgments. Unfortunately, we're out of time, and I want to cover the 1031 exchanges, which we didn't get to. Do you have a chance to come back next week so we can talk about that next Sunday?
Absolutely.
All right.
It will be my pleasure.
All right,
Thank
great.
you.
We're going to have you back next week. And AJ, once again, can you please give the listeners your contact information so they can reach out to you? They're going to need help.
Absolutely. It's my pleasure. Thank you. So my cell number is 908-380-6876. Ajay Kumar CPA. If I'm not able to pick up your phone, please mention Can and Jane Show. The consultation is free, and I'll be happy to take your call. Just text me, email me, or give me a call. Thank you, and I will see you next week. I'll be with you next week. Happy New Year, everyone.
Thank you so much, AJ, for taking time to be with us on this New Year's Day. We want to wish again everyone a happy and healthy New Year. Thank you.
Thank you.